If you're a newer trader, it's very easy to get confused with all these different types of price action concepts. And if it feels like every trade you take is a loss, or you have a small green streak only to have one bad trade blow your entire account, this video is for you. I've been trading for the last 7 years, and in today's video, I'm gonna share with you 3 of the most important price action concepts that helped me become a profitable trader. And then I'll share with you real examples using these concepts that I took in real time. Let's get into it. Okay, so in today's video, we're going to talk about price action concepts and why I believe price action is one of the most important concepts that you need to understand as a trader. And a lot of the information on price action can be a little bit confusing because everyone tells you to trade price action, but no one really tells you exactly what you should be looking for. And I've broken it down into 3 steps that I feel like are very important. So we're going to talk about the 3 simple steps on exactly what you need to be looking for when specifically trading price action and price action concepts. So starting off with number 1, which is the direction of the markets. You need to understand where the overall markets are heading and what it's doing on the higher time frames. Number 2, the location of the markets and where you want to be placing trades from. And number 3, the execution. Where are you taking trades? How are you taking trades? When are you looking to take trades? And it's important to mention that you need all 3 of these steps in order to become a consistent and profitable trader. And you cannot skip any single step. In order to execute properly, you need to understand the direction and location of the markets. If you skip the first 2 steps and hop right into the execution, then you're most likely going to be losing the markets because you're trading blindly. So having all 3 steps in order is going to be key here. And that's exactly what I'm about to break down in today's video. Number 1, the direction. Who is in control? And it can be broken down into 2 simple things: buyers and sellers. Are the buyers in control? Is price moving higher, forming higher highs and higher lows? Or are sellers in control and we're in a clear downtrend, forming lower highs and lower lows? So basically, price control can be broken down into 2 things: an uptrend and a downtrend. There's also one more, which is a consolidation, where price is neutral. So as you can see right here on the left hand side, I'm going to quickly go over this. You guys have probably seen this plenty of times, but what we have in this case is an uptrend in the markets. We're making higher highs, forming higher lows, and we're continuing to push higher. This is what happens when price is moving higher. We're in an uptrend. Buyers are clearly in control, forming bullish market structure. Second, what we have here is consolidation, where price is neutral. As you can see, buyers and sellers are in a neutral stance in the market where we're not moving higher, we're not moving lower, we're essentially ranging, or what's called consolidation. And then number 3, what we have on the right hand side is a clear downtrend in the markets, where as you can see, we're making lower highs and lower lows. This is when markets are pushing lower, and this is what's called a downtrend in the markets, where we have bearish order flow, and this is when we're going to be looking for sell positions. So as I mentioned, we're just going to be focusing on trends, so we're going to be looking for uptrends or downtrends. And we also have the third one, which is consolidation and chop, which is where we want to be hands off in the market and we want to be a little bit more cautious. Now let's hop into the charts to see exactly what this looks like. So as you can see, we're on the charts here, we're on gold futures, and what we're going to talk about first here is the direction of the market. It's basically asking ourselves, who is in control? Are the buyers in control, or are the sellers in control? So there's 2 possible scenarios that we're going to be looking for when looking at the charts. So as you can see right here, we're clearly in an uptrend in the markets. We're making higher highs, higher lows, higher highs, higher lows, and we're pushing in a upwards trend. Whenever we're making higher highs and higher lows in the markets, this is what's called a bullish uptrend. And this is very good because we want to be trading in trending markets, and trending markets offer the best opportunity. The exact same thing applies if we're looking at this towards the downside. So right now I have this chart inversed. If this was the complete opposite, we would be in a clear downtrend. As you can see, the overall markets are trending downwards. We're creating lower lows, we're creating lower highs, and we're pushing towards the downside here on gold on the daily chart. Whenever the markets are downtrending, this is also good as well. So as I mentioned, we're either going to be looking for uptrends or we're going to be looking for downtrends in the markets. There's also one other scenario, which is when the market is consolidating. So as you can see, I zoomed out on the charts here, and what I want to talk about here is the third possible scenario, which is consolidation slash range. As you can see, the market's going from range low to range high, from range high back down to range low, and so forth. And this is what's called a ranging market. When the markets are ranging like this means that there's no clear direction on the higher time frames. So buyers nor sellers are in control and they're in what's called equilibrium, and there's no trend in the markets. So just a quick little recap, we want to understand who's in control, the buyers or the sellers, and that's going to be key, and that's our first step, which is understanding the direction of the market. And to simplify, are we moving higher or are we moving lower? Now let's go on to step number 2. Second is location, where to place trades. This is very important because we just don't want to be placing trades in random areas in the markets. What we want to do is place trades where there's the lowest risk and highest reward possible, otherwise known as our narrative. So it's basically asking ourselves, if we are going higher, where are we going higher from? Where are the key areas in price that we're going to be looking to place trades? If we're going lower, where are we going lower from, right? This is very key to ask ourselves because, as I mentioned, we're just not going to be placing trades in random areas. We want key points of interest in the market. So let's talk about points of interest, otherwise known as our narrative. And where are the key areas and key points of interest that I look for every single day? Number 1, old highs and old lows. Classic. Swing highs and swing lows in the markets where there's liquidity resting above and below those areas. That's where we're going to be looking to place trades, take profits, stop losses. We're just going to be looking at these areas in price because they're key points of interest and they have a lot of liquidity. Number 2, previous day highs and previous day lows. Another key level that we mark out every single day because there's a lot of liquidity once again. And finally, your market open and close, otherwise known as your opening print and your previous day close. These levels are very key as well, specifically your opening print because there's a lot of liquidity in that first candle. And of course, your previous day close, if there's any gaps in the markets, there's going to be imbalances. So the markets are usually going to gravitate towards those key levels. So with this being said, let's hop right into the charts to understand exactly what points of interest are and where to frame trades off of. Now we're back on the charts here, and what we're talking about is location. And location is very important to understand the point of interest and where we want to be looking to form trades from. So as I mentioned, there's really 3 scenarios and 3 points of interest that I like primarily. Number 1, old highs, old lows. Number 2, previous day highs and previous day lows. And number 3, market open / market close, which is basically your opening print and your previous day close. So as you can see right here, the first thing that we're going to talk about is old highs and old lows in the markets. So for example, if we were to draw this old swing high, you can see price ends up gravitating up and towards the swing high, sweeping out the swing high, and then we end up having this nice reversal towards the downside. So this is a potential trading opportunity where you can look to take this short back towards the downside. You can see once again, if we mark out this brand new swing high, price ends up moving higher, sweeps it, comes all the way back down. Another possible short entry off this swing high. And then another one, as you can see right here, sweeps it once again, a little bit of reaction. Once again, another reversal created at this swing high. And we have this nice reversal back towards the downside, back down in towards this swing low. So as you can see right here, these swing highs and swing lows in the market are very, very important. We can be looking to sell our existing entries. We can look to take short positions off those levels. So these levels have a lot of liquidity resting above and below them. So they're always going to be key points of interest that we can be looking to take trading opportunities from, or we can look to take trading opportunities up in towards those levels and look for profit targets. So this is very key when it comes to trading in the markets. So this is what's called old highs and old lows. Next, what we have is our previous day highs and previous day lows. So for example, if we were to mark out our previous day highs and lows here on the charts, you can see how many trading opportunities there are around these key levels. So right here, as you can see, I just have this old high marked out, which happened to be at one point a previous day high. You can see price breaks above it, nice continuation towards the upside. The day after, nice bounce play. That's a potential opportunity that you can take. The day after, rejection, you can take this all the way back down in towards this low. The day after, reclaim, nice push back towards the upside. You can keep marking out these levels and these key points of interest here in the market. If I was to mark out another old high, which at one point was a previous day highs, you can see these levels, as I mentioned, can be used as targets. Once price breaks above this level, you can see nice retest. 2 days later, price comes back down, rejects off this level, comes back down in towards this key level right here, which is your 384, and then so forth. Other levels that we can have marked out, we can mark out these old highs. You can see nice resistance that end up turning into support. And then finally on this day right here, another rejection back towards the downside and towards that 390 that we can extend over. So as you can see right here, these are just key points of interest in the market: support, turn, resistance levels. I just drew out these levels that just happen to be your previous day highs and previous day lows at some point. And you can see how well these levels are respected. You can see there's multiple touches when I extend these levels over. There's multiple reactions. There's multiple potential trading opportunities off of these levels. And what's so great about trading the previous day high and previous day low retest is that there is no bias. You can trade both upside and downside, and there's always going to be the best opportunity around these key levels with the lowest risk and highest reward possible. Now let's go on to the third point of interest, which is your previous day close and your opening print. So right here, we're on our third key point of interest. We're on the SPX. So if you want to be looking for your previous day close along with your opening print, you can do this on names that are primarily traded on the New York Stock Exchange. The main time frame that we're going to be using in this case is the New York session open, which is at 9:30 a.m. Eastern Standard Time. And of course, 4 p.m. Eastern Standard Time, which is the market close. This is going to be key because this is the New York session open. It's when the stock market opens, and this is when there's the most volatility and liquidity in the markets. So these levels are going to be respected the most. So as you can see right here for the SPX, the levels that we're going to have drawn out, as I mentioned, is going to be your opening print along with your previous day close. So for our first example, let's talk about this day right here. We can draw out our previous day close and we can draw out our market open. And you can see right off the bat, price pushes higher, comes back, retests that opening print, nice continued push towards the upside, ultimately never closed that full gap that we created, and then came back towards the downside. You can see the next day, let's draw out our previous day close, and then we can draw out our market open again. In this case, price ended up pushing back up on the first day, ended up filling this gap that we created, rejected off this level, came all the way back down, filled its full gap that we created on the day of that it gapped up, and then kind of consolidated the rest of the day. Let's go into the next day here. We can mark out that previous day close along with market open. As you can see, price ended up pushing towards upside, filled its gap that we created, retested our previous day close, end up having this nice continuation towards the upside. Another key level, previous day close, and of course we can mark out market open, drag it over. Within the first 15 minutes, already filled the gap towards the downside. Couple reactions around your previous day close, but you can see how well price respects these levels. If I keep going, previous day close along with market open, nice opening drive towards the upside, came all the way back down where, filled its gap fully, couple bounces off this level and pushed back towards the upside. So you can see just strictly based off of the levels that I talked about today, a lot of them are just old highs, old lows, internal liquidity or external liquidity. They're just very key levels on the chart. If you go back, mark out these levels either being your old highs, old lows, previous day highs, previous day lows, or your previous day close and your market open, you will see how many trading opportunities there are around these key levels because that's exactly where we want to be trading. And finally, execution, when to place trades. So as I mentioned, we just talked about the first two, which is direction and location. Now we're going to talk about execution. As I mentioned, in order to execute in the charts, you have to have the direction and the location. You cannot execute on the lower time frames without the direction and location. Why is this the case? The reason being is because if you don't have context in the markets, it's going to be very difficult for you to become consistent. You need context, you need logic. So that's why the direction and location is important, because you can't just execute on the lower time frames without that higher time frame direction. So first, let's talk about the time frames when it comes to execution and entries. And what we're going to be doing is executing on the lower time frames. In this case, I love executing on the 1-5 minute. These are the key time frames that I use when trading momentum. We're going to talk about the different types of time frames in correlation to the narrative, because not everyone is going to be on the lower time frames. It depends on how you trade and what type of trader you are. So as you can see right here, you might have seen this graph before. I love explaining this graph because it's very important. As you can see right here, what we have is a daily narrative, which is the location. So let's say, for example, we have a daily break break and retest on the higher time frames. And now we want to execute on the lower time frames. So what we have is an entry on the 1 minute chart. Why is this a problem? The reason why this is a problem is because there's a lot of distance in between the time frames. So if you go from the daily chart all the way down to the 1 minute, you're basically going from the daily, 4 hour, 1 hour, 30 minute, 5 minute, 1 minute. That's about 6 different time frames that you have to flip through in order to get to that 1 minute chart. And by the time you're on the 1 minute time frame, you're already going to be confused on what's going on the higher time frames. So you're most likely going to end up missing the entry. So what is the solution in this case? So right here, this is a graph that I abide by, and it's something that I've been using for a very long time. So make sure to take a screenshot of this and use this for future reference. So right here, what we have on the left-hand side is your location, otherwise known as your narrative. And then on the right-hand side, what we have is your execution, other known as your entry time frame. So for example, let's say we have a narrative on the weekly and the daily time frame. What does this mean? That usually means we're on the higher time frames, and where do we want to execute? We want to execute on the daily and 4 hour time frame. So this is specifically for position trading and long-term investments. So you're really not going to be using this time frame if you're going to be day trading, more position trading and long-term. If we go into the time frames lower, for example, the 4 hour and the 1 hour time frame, now our execution and entry is going to be on the 1 hour and 15 minute time frame. This is really good for swing trading and longer term day trades. So this is really good if you're trying to capture a higher time frame thesis. Maybe you're swinging for a couple days or to a week. This is very solid. And then finally, what we have here is the 15-minute time frame, and then we have your entry on the 1 minute time frame. What is this good for? This is good for day trading / momentum trading. And you can see a pattern here. The pattern is, if you have a narrative, where do you want the entry to be? You want the entry to be at least 2 time frames away. So for example, we have the 15-minute narrative. We're essentially 2 time frames away. So we have the 5-minute, and then you also have the 1-minute time frame. So this gives us a nice higher time frame perspective. It gives us context and logic. So when we're on the 1-minute time frame, we understand what's going on the higher time frames to give us more of a perspective. So 2 time frames away is a good rule of thumb. If you're on the weekly chart, your execution can be on the daily. If you're on the 15-minute, your execution can be on the 1-minute time frame. As I mentioned, 2 time frames away. So now we understand the time frames that we're going to be using. I had to get that out of the way just to make that clear. Now we're going to talk about the actual confirmation entries and how to enter in a trade. And this is one of my favorite, which is the 3-bar pattern. So as you can see, I'm back on the chart. Now I want to talk about the execution / entry. And what we're going to be talking about here is when to enter a trade. So one of my favorites is what's called this 3-bar entry confirmation. So in this case, what we have here is a bullish 3-bar entry confirmation, meaning price is uptrending and now we're pulling back into some sort of key point of interest, being that previous day highs or previous day lows. Now what we're going to be doing is waiting for this 3-bar entry. So what we have here is that first candle. The first candle is called our lead candle. This is the candle that pushes down in towards our higher time frame key point of interest. And this candle right here is fairly important because it gives us the context if this is going to be a potential entry or not. When we have that nice push down in towards the retest level, we want to check out the size of the candle, how fast the candle is approaching our key point of interest. Are we having a big candle? Are sellers stepping in aggressively? Or do we have small body candles and we're slowly pushing down in towards the retest level? How is the candle forming in real time? Number 2, what we have is what's called our reaction candle. This candle right here is one of the most important candles out of them all. So as price is coming into the retest level, are we seeing the buyers step in, right? As the candle's forming, are the buyers present, right? Let's say sellers are stepping in, but the buyers are immediately trying to push price back above our key point of interest. Sellers keep stepping in, but it keeps pushing price back above. And you can clearly see while this candle is forming in real time that the buyers are there. And let's say we close above, awesome. If the buyers start pushing this back up and it flips green, that's great as well. The color of the candle doesn't matter as much as the overall reaction that we have off of the key point of interest. So our third candle is what's called our confirmation candle. This confirms if price is ultimately going to move back towards the upside or if we're going to end up failing, breaking back underneath our key point of interest and continuing lower. So this candle, as it's forming, is going to be very key. So now let's say as this candle is forming, right, we end up closing above its second candle high. This means it's fairly bullish and most likely going to continue back up and towards high of day and above. Let's say if this candle closes above its first candle, that means it's very bullish and it's most likely going to continue higher. Let's say as this candle is forming, it has a huge wick and rejects and it actually closes at low of day and it turns red. What does that mean? That's a good indication that this setup is going to fail and most likely continue lower. This third candle is going to be that confirmation if price wants to continue higher or if it's going to fail. And for entries, what we can be looking for once the candle closes, you can be looking for long entries with a stop underneath this candle closure for continuation back up and towards high of day and above. If this candle closes at high of day, you're going to be waiting for the candle closure plus continuation here as well. A few other entry models, of course, is you can wait for that second candle to close with a stop underneath for continuation, but this of course is going to be lower probability because you're not waiting for the confirmation. And then one of my favorite entries, which is a little bit more discretionary, but it's basically when the candle shows momentum and breaks above its previous candle high as this candle is forming. So this candle right here still has not closed, but as it's forming, as soon as buyers step in above your second candle high, you can look for a long position with a stop with a break underneath that second candle low, looking for this candle high plus continuation back towards the upside, hoping that this candle closes bullish and then ends up having that continuation towards the upside. So this third one is a little bit more advanced. It's a little bit more discretionary, but the main thing about that second one, if you do want to be aggressive, what do you need? You need context and you need a good narrative. That means you need the first step to be very clear, which of course, as I mentioned, is the direction of the markets. And then you need the second to be very clear as well, which is the location. If you have the direction, the location spot on, then you can be more aggressive on number three, which is the execution. If you just focus on the execution, as I mentioned, without the direction or the location, you're going to get absolutely smoked because you don't understand the context and logic. So right here is the entry model, but now we have to combine it all together to give us those high probability setups. So now let's go into some examples that I took in real time to show you exactly what I'm looking at. So first things first, we're going to have to go in order. So what we want to do is figure out the direction of the markets. Where is the market heading? Are the buyers in control or are the sellers in control? If we're looking at MU here on the daily time frame, we can clearly see that the buyers are in control. What are we doing? We're making higher highs, higher lows, we're making higher highs, we're making higher lows, and we're continuing to push towards the upside. So we have a clear bullish market and the buyers are in control. So number one, we already have checked off. So number two, now we're going to be forming a narrative and we're going to find the location of where we want to be taking trades. So now we can do this on the lower time frames. So as you can see right here, now I'm on the 15-minute chart. I'm going to be looking for the location of where we want to be taking trades. So coming into market open, the level I'm going to have marked out, previous day highs and previous day lows. To me, this is very clear. If we want to see some upside, we need to see the break above your previous day highs for continuation towards upside. Of course, another possible scenario is the bounce off your previous day lows for this push higher here as well. If we want to see some downside, potential all-time highs rejection for this push lower, but of course, the higher time frame is bullish, so we much rather look for long positions. So now let's have these levels marked out so we can mark out our previous day highs, drag it down to this body, and we can mark this out. Similar thing here, previous day lows, we can drag this towards the downside and we can mark these levels. So coming into market open, we have the direction in this case, which is bullish. We have the location on where we want to take trades off of, which is that previous day highs. Now let's go into the lower time frames, which is our entry / execution. So coming into market open, now what we're waiting for is the break above, retest for continuation towards the upside here on MU. First candle is showing a lot of strength here. So now all we're doing is waiting for the retest. And bam, as you can see right there on MU, we have that push down in towards our previous day highs. And as you can see, what we form here is that 3-bar confirmation. We have your first candle, which is the lead candle. We have the second candle, which is the reaction candle. And that third candle, you can see a bunch of buyers stepped in. As price was forming, we can be looking for an entry with a stop just to break below, and we can be looking for continuation back towards the upside. So this is exactly where we can go looking long with a stop just to break below. And of course, we can be looking for continuation back towards the upside. In this case, we opted for a more aggressive entry approach just because The higher time frame is bullish. We're at all-time highs. We're showing a lot of relative strength. We're above your previous day highs. So this is the exact trade that we want to take if we want to be a little bit more aggressive. I did take this in real time, of course. If you want to take a look at every single trade that I take, I post them on my second channel. So make sure you check that out. Every single trade that I take, win or loss, will be posted on that channel with an in-depth breakdown. So make sure to check that out if you already haven't. Now, with this being said, we can play out the tape here. And as you can see there on MU, we end up having that super solid break and retest right off that previous day highs, waited for that confirmation candle, and then we ended up having that nice aggressive push right towards the upside. So this was a great example of exactly how to use all three price action concepts in combination with one another, starting with the direction, of course, then figuring out the location, and then waiting for that solid sniper entry. Now let's go on to another example that I have for us today. So as you can see, I'm on my next example here on NVDA, and we're currently on the daily chart. So as I mentioned, the first thing that we're going to do is find the direction of the overall markets. And what we're going to be doing is look at the past 20 to 40 sessions on the daily chart. As you can see, pretty big upper rejections, continuation towards the downside. Ended up finding a nice bottom here on NVIDIA, and now we're bouncing and we're having a little bit of a pullback here. So in this case, just by analyzing this daily chart, I am fairly neutral. So if that's the case, the higher time frame isn't as clear. You can do one of two things. Number one is to head onto the lower time frame. So if you're on the daily chart, you can go down onto the 4-hour or 1-hour time frame. Or number two, you just want to be a little bit more cautious and maybe potentially not take a trade because the overall direction on the higher time frames is not clear. So let's go for option number one. In this case, let's go down onto the 1-hour time frame. So as you can see right now, we are on the 1-hour time frame. We zoomed in a little bit to now give us a little bit more of a clear trend here in the markets. What we have here is a clear high that we've created. You can see there's multiple rejections off this level. We have a clear low, which we have bounced off multiple times. We now break underneath this low. We have a couple of rejections. So in this case, I am leaning a little bit more towards the downside here on NVIDIA just because we broke underneath key levels. We're rejecting off this 187 here now. So we can expect a little bit more continuation towards the downside on NVIDIA. Now we have the direction, which is a little bit more clear on the 1-hour chart. We're leaning a little bit more towards the downside. Now we can go on to the 15-minute time frame to give us the location of where we want to be taking trades. So now we're on the lower time frames, and the key levels that I'm going to have marked out, of course, is going to be our previous day lows. You can see there's 1 touch, 2 touch, 3 touch, 4 touch. We have multiple touches on NVIDIA off this 184. So that's going to be a key level, of course. And then the next key level, we can kind of have marked out your previous day highs. So if you want to see some downside, of course, now it's going to be underneath 184 for this continuation towards the lows. If we want to see some upside, then we either want to see the bounce or, of course, now above your previous day highs. But since we're leaning a little bit more towards the downside, we're going to be looking for that previous day low retest for continuation towards the downside here on NVIDIA. So now let's draw out this level from your previous day lows. We can draw it out to the body, and now let's go on to the lower time frames. Let's play out the tape. So as you can see right here on NVIDIA, within the first 2 candles of market open, really strong push towards the downside, now breaking underneath our previous day lows within the very first 2 candles. Now what we're going to be waiting for, of course, is the retest off that previous day lows for that continuation towards the downside. So as you can see right here on NVIDIA, we're now getting that push right back up in towards our previous day highs. You can see that first candle that's leading the market back up in towards that previous day lows. We now have that reaction candle. You can see sellers are immediately stepping in. We have a weak candle closure. Now let's wait for that confirmation candle, which, as you can see, we get on that very next candle right here. So this is our signature and price that we can be looking for shorts towards the downside. We can go in short here with a stop loss just to break above. And of course, now we can be looking for continuation towards the downside. As for our entry models, we can enter in on this candle close. We can enter in as it breaks underneath the second candle low. Regardless, both these entries are good. And now we can be looking for continuation lower towards the downside. Now let's play out the tape. And as you can see right there on NVIDIA, we end up having that nice retest right off that previous day lows for that continuation towards low of day. And of course, below down and towards our final take profit. So as you can see right here, this was another great example of using the 3 simple price action concepts that I taught in today's video, understanding the direction, the location, and of course, the execution in the markets. And with that being said, I hope you guys did enjoy the video today. I do want to mention that I started up a second channel breaking down every single trade that I take on a day-to-day basis, either if it's a win or a loss. So if you want to check out my full thought process, the second channel is going to be posted in the link below. And of course, if you guys do want to join my pre-market preps every single morning, I do that every single day at 8 a.m. Eastern Standard Time. If you guys want to live trade with me every single day, that of course is in the description below. And with that being said, I'll see you guys next week for a brand new video. Peace.